Very good evening, everyone. Welcome to Admiral Markets. My name is Chris. Nennet is also, of course, joining us today in How to Scale In and Out Part 2. We had Part 1 last week on Thursday as well. And you can see the first part on YouTube. When you go to the Admiral Markets YouTube channel, you can find the webinar right there. We're going to discuss the second part, primarily a bit more focusing on to how to scale out this time. Last week was a bit more on the scaling inside. And before we do that, though, let me quickly test if you, or check if you can hear me, first of all. So if you could just quickly write a yes or okay, that'd be perfect. And also I have to make you aware of these disclaimers. First of all, this webinar is shown to a global audience, but may not be suitable for everyone. Please take a look at this link, select your country of residence, and contact an appropriate entity to find out more information about that. Also, please be aware that trading for exchange and global financial markets is considered high risk and may not be suitable for everyone. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice, it is for informational and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer, plus you're aware of the risk involved when trading. All right, we got some interesting info, but first of all, wanted to let you know that Admiral Markets has a Supreme Edition, a lot of extra features, as you probably know, and about 2 months ago, some extras were added, so there are about 60 features in total. Plus, we have WebTrader, which makes it possible and very easy to trade from the web browser as well. All right, so take a look at admiralmarkets.com. You can click on trading platforms right here, and you get all the info you need. Use analytics, of course, for wave, fundamental, technical analysis, education for webinars, and here you find more information about how to start trading as well. All right, great. Thank you so much for confirmation, Marco and Lau. So let's start with taking a look at the definition. What is scaling out? Well, it's basically pretty straightforward. It's just exiting the same trade on the same instrument, in the same direction. So if we go long on the euro dollar and we enter at 110 and we exit a part of the position at 110.50 and another part at 111, we made 50 on the first position and 100 pips on the second, and we just scaled out. We took part of it, at the 50 pip range profit, and the second at plus 100. And that's one way of scaling out. And you could do that, I guess, even more than twice, right? You could do that 3, 4, but eventually it doesn't really become practical to do it 100 times, obviously. So, but definitely a few times is normal, and you can scale out like that and take profit as the trade hopefully develops. All right, so here's an example. Using fibs, you can see exiting at multiple spots. So basically what that could mean is you look at the first purple fib here, and we place it on the first swing high, swing low, where it's very, very small, but still. And one of the scale outs could have been at the first targets of the purple fib, like the minus 61.8 that we often use, or the minus 100 target. And a scale out could be higher. A second exit could be higher, and a higher fib, right? That is equal to also the orange fib. You see the orange fib, that's the second fib. And you see that there's targets equal to the purple one. The purple has minus 200 here. And the orange has minus 61.8. So that could have been one of the scale outs as well. This could have been the first one, this could have been the second one, and perhaps later on you see even more confluence around here, and who knows, that could have been even a third scale out potential. Just to give you an idea how you could do that using targets and multiple swing highs and swing lows. So you just use multiple swings, place those fibs on the swings, on each swing, and you'll see basically where targets are and where they also have a confluence with each other, where multiple fibs come together at a certain level. So what are the advantages, first of all, and then we're going to dive into some specifics how you can use scaling out using different tools, and then Nana is going to take a look at his part as well, of course. So first of all, the mental side of things. Why is it good to scale out? Well, I like that because I think there's less pressure on necessarily taking profit right here, right now. If you're up a few pips, or let's say you're into a profit that you find desirable, for some that could be 20, others could be 50 pips, depends how you trade. But whatever is tempting for you to think, okay, this is actually a nice profit, but your target is actually a bit further away. But that could be a bit annoying because you got already profits floating, and you have actually a target further on, and there's a bit of a friction there because do I take the profit now, kind of break perhaps my trading plan even, and just grab what is already in my lap in a way, or just grab what I have already in my hand, right? Or do I continue and kind of go against that pressure, or lay that aside and say, okay, I'm tough enough to stay in that trade, but then of course face the music and the consequences when the currency and price might retrace against our position, and that might start to annoy us as well, put kind of a fear into us because we had that profit and now it's retracing against our position, and all of a sudden we're down, right? So to put it in a schematic here, maybe a bit easier perhaps. Here we're plus 50, we're aiming for 80, we're doubting what to do, we stay in the trade but we see it fall to 20 and we're like, oh no, what did I do, right? Or the other way around, you take the profit at 50 but you just see it continue to skyrocket right to 80. It almost seems whatever decision we take, it's always going to be the opposite that was better. And if we do the opposite, then it was the original decision that was better, right? It's Murphy's Law. So by taking a bit of profit along the way, kind of helps, right? We got a bit of profit already in our pocket, and we could have maybe a bit more patience in waiting for the target. We got therefore also the consequence of that is just a better ability to catch that big win, because if we close at 50 pips or 30 pips and our risk is 30, for instance, it's a nice win, nothing wrong with that win, but it's not a huge R to our reward to risk ratio. Whereas let's say we're aiming for 120 pips, right? On a pound yen, that could easily happen. And the risk was 40. Those 3-to-1 trades, 4-to-1 trades occasionally are very, very useful and give a good equity curve. So by scaling out, there's a chance that we can get that larger win a bit easier perhaps. Also, there's less fear of us losing all that open profit. And then of course there's also the risk management side of things. There's risk off the table, which means that if we close some profit, that the entire trade could be risk-free, or even in profit. There could be therefore a better margin position, and we are also able to enter a new setup. So that means that we got new opportunities to trade. Perhaps that could be a difference if we close part of the trade. So yeah, those are all the advantages, or some of the advantages. Now, just a bit about why I think scaling out is good is because from a psychological point of view, if you're interested in this, I would recommend to read The Time Paradox. It's a book from, I think it was Philippe Zimbardo. On page 283, he talks about how our risk appetite changes depending on basically whether we're in profit or in loss. So if we're in profit, we tend as humans to become risk adverse and tend to be more cautious and take decisions that are conservative perhaps. Whereas if we're losing, we tend to on average become risk seekers, and we want to we just become a bit more casual with that. Now, how much, of course, really depends from person to person, and some of us might not even fit this description. But on average, right, most of us are like this. Some worse than others, but that's just apparently a very common human nature. And now that you know this, you can pay attention to it, and maybe you can avoid some of the bad consequences that go along with it. And one of the bad consequences, of course, is a big account hit. We start losing a bit, we want to regain it, we want to get back at it, we want to get the money back, and we start revenge trading, and then we get another loss, and then the losses start to become bigger, and the equity curve starts diving downwards. And part of that reason is because our appetite to risk is higher, and traders can become numb in a way, don't even realize what's going on, kind of go into a world of its own, and don't think through the consequences of their actions, and just kind of lose reality, lose contact with their plan, and when the dust settles, you look back and you think, oh my, what happened, right? That it could be very disastrous. So that's the things you want to avoid, be very cautious of. So solutions to that is scaling out. One of those is scaling out, starting with lower risk, keeping the units of risk small, obviously, having a daily limit that can never be broken, always having a conservative and kind of a defensive posture in mind. If you're a very big risk seeker, that would be good. If you're very risk adverse, well, then that probably would not help you too much, but you might want to not cut down on risk too much when you're in profit. So it depends on who you are. If you're a big risk seeker, be careful, be more defensive at all times. If you are very cautious of risk, overly cautious, perhaps that could happen, then don't become too cautious perhaps when you're in profits, right? And I think scaling out can help with this because you're locking in profit, which gives you the feeling of being a winner, and that feeling helps us become risk adverse. So scaling out is also a psychological trick to calm us and be patient and have a feeling that we're winning, and that makes us actually kind of, I think, push us into a risk adverse scenario, and that's typically good, unless you're an exception and you're really, really, really very, very conservative in your risk approach. So some dangers, and then we'll really move on to charts. Drawbacks. Well, we're going to have wins that are varying. One could be a bigger profit, the other could be a bit smaller. So you want to make sure that your average win is not decreasing because of this. If you see your average win becoming smaller after you start scaling out, then something is not optimal. If you always close entire positions and your average win is 1.4 of your average loss, and you start to scale out and you see those statistics decrease, well, then apparently obviously something is not optimal. Well, you have to investigate it. It could be because of other circumstances, but it's something to keep an eye on. So yeah, that's what you want to measure. You want to keep an eye on those statistics. You might want to have a bit more experience. Where are those levels? What could represent good levels for scale outs? If you're just starting out, it could be a bit overwhelming to look and consider all of those factors. So a tad more experience might be useful. A bit more confidence in the system. More confidence in your own system could be useful too. All right, so let's move on. Take a look at some Fibonacci targets. One of the my prime ways of exiting with scale outs is using Fibonacci targets. Well, first of all, they're great levels. They're very well respected. Market just, in my opinion, is very responsive to them. I truly am obviously a big fan of them, as you know, and I just see it happening all the time. I see it happening day in, day out, these levels being respected. Now, yes, sometimes price does go through it, skips the target, and goes to the next, but just like any fib retracement as well, but there's a high percentage where price does respect it, stop it, bounce off of it, even reverse from it. So this is an example where you can see the price hitting the 272 target and the minus 61.8 target after hitting the 61.8 fib, falling nicely to both of those. So yeah, that could be obviously a scale out. This is not a best example, it's a high time frame, but you get my point that you can use targets to say, okay, I'll get a bit of, I'll exit there a bit and exit there a bit, and maybe could even leave a third portion on and use a trail stop for the remainder. And the benefit is because price, we don't know how price, how far it could go. Sometimes it goes to the minus 100,000 target. Sometimes it doesn't. So by scaling out, we get the benefit of grabbing some profit at the nearest target, but leaving a bit of position on for a target that's a bit deeper and gets a better R2R. So especially if there are targets, sometimes I go with my entire focus on one target because I think there's confluence at that target, and I think that that's the most attractive target for price and market to move to. At other times, both targets look just as likely that there could be a bounce and price respecting those levels. And then I might go for the nearest target, or I might split and divide it among two positions, right? These two targets, for instance. Here you got more examples. You can see on the left here, green circles bounce, and you can see green circle first exit right here, and second exit right there at the fib targets. Here, minus 272 target, minus 61.8 target, minus 2000 target. Here too, a small bounce at the 272 target, but ultimately moving down to the minus 61.8 target. When I talk about targets, I'm talking about minus figures, which means that these targets are above in a bullish variant or below in a bearish situation. All right, and they represent targets, so I don't have to add a Fibonacci expansion or extension tool. I only use the retracement tool. So I have a 23.6 fib on. 23, I do use it. Here's the top, and then I have all the other fibs, okay, all the way down to the 100 level, and here's the 38.2. Okay, but by adding targets, minus numbers, the minus numbers in this case in the bullish situation are therefore projected above the top, minus 27.2 and minus 61.8. All right, these are the targets I'm using. Those are the main targets for any of the positions. Sometimes price does accelerate when it's strong in a trend and when there's a good impulse. Okay, so 23.6 is a retracement. And here you can see some examples. You can see the pink fib representing Fibonacci retracements. And there's an orange fib here and a brown fib. And you can see a confluence at this level. And you can see price bouncing out that level and then going to these targets. So in this case, it might be wise to not to scale out because we got a lot of confluence in this level. And there are a lot of levels there indicating that price could have a struggle there. So when that happens, it could be a lot better just to say I'm going to take all of the profit, forget the scaling out, or I scale out part of the trade here, but the other part I might even go here. There could be various reasons, but it might not make sense to aim higher than this. So that could be a reason to say, okay, I will not scale out on this chart. Very strong confidence could make it better to aim for only one area. All right, here's another example. So this is retracement instead of targets, and part of the scaling out design could be to aim for retracements. So if I'm taking a reversal trade, I'm looking for basically a reversal, no, I should say continuation of the trend at any of these fibs, right? This is obviously moving down. So if I manage to take a trade like here and I took the reversal breakout to the upside, what will be my target? Well, my target will be these fibs because price is moving lower, right? Looking at the red arrow. And this could be a retracement, hitting the fibs and moving down again. So what fibs could be used? Well, I use wave analysis often to understand which fib could be more likely. But in general, of course, scaling out at the various fibs is not a bad idea. Any of these fibs could be the turning spot. We don't know. We never know for sure. So aiming for part of the trade for one of the fibs and the part of the trade for the other fib could help us optimize profits, and is not a bad idea of approaching it. All right, so if we took some profit at 38.2 and some at the 50, great. Or even better, if we took a bit of 50 at the 61.8, perfect. In this case, especially. So that's one thing. You want to take a look at retracement levels. Here's another example. All right, we see a classical zigzag. You see this impulse right here. Do you see this bear flag right there? And do you see another break of the bear flag and then a zigzag? It's a classical ABC correction. You've probably heard of that before. Many people, traders, use ABC. It's actually an Elliott wave term, but not only Elliott wavers necessarily use it. But you can see it's a very classical reversal or retracement, I should say. 3-wave, uptrend, boom, boom, boom. So a trade could have been down to a target, could have been any of these fibs, especially the 61.8, especially if you see this fall that fast and you see a bear flag. Then the 38.2 fib was not the turning spot, but just the bouncing spot. And then most likely these fibs are going to be the ones that are going to turn price back up again. So this way we can target those retracement fibs. All right, moving on to moving averages, I think that's another way of scaling out, for instance, is the fact that if price is either, first of all, going back as a reversal trade, the target could be the moving averages themselves. Let's say in this example right here, right, targeting the long-term moving average here, the purple moving averages could be a first scale out or the last scale out. You get my drift. Or if price is, let's see, moving back to this short-term moving average, right? Even if it's moving away from it, we can use trend lines, and that's the next topic, to understand where the resistance could be. Because with moving averages, obviously, we're looking for price to go back to the average, and we're looking for bounces and continuations in that trend. So trend channels and trend lines we can use, like this is a perfect trend channel, very, very, it's very, how do you say it, equal to each other, very balanced in its decline, very good angle, and we could use it for scaling in and scaling out. We could use it for scaling out by looking for targets at the bottom of the channel. Whenever price reaches the bottom, we can see that that could be a reason to scale out one of those positions, right? Because in many of these cases, when price does reach the bottom or the bottom quarter at least, then yeah, there is a good chance of some retracement or consolidation. So why hang in there if we can grab some profit and maybe re-enter at a different spot? Let's say in a very good scenario, we exited here and we re-enter right here. No, that's perfect, right? Some cases, yes, price goes a bit further. If we exit here, we missed a bit of profit here. Same for here and same for here. But that's okay. That's why that's why we have channels and we look for take profits. You cannot always perfectly aim for the very last pip. So if we scale in part here and then the next part here and the next part here, you're getting optimal exits and still letting on a trade for next part. Trend lines we can use for scale outs as well. One part could be, for instance, at the top of the trend line here, and the next could be waiting for the break. Doesn't have to be always only the trend line. It could be part of the trend line and part of the fib, for instance. Part could be here at this trend line and part maybe at the next trend line. And most of all, of course, is using it for Confluence. If we combine multiple tools and just see where the areas are that have the most Confluence, where we have fibs and trend lines coming together and maybe support or resistance from higher time frames, the more evidence we have, in a way, the better. Now, we want to be careful, of course, when I say that. I don't mean that we want to use 500 indicators and 600 tools, but I mean, a couple of these things and put them together does make sense. If we use a pivot point and a trend line and a fib at a moving average, I think that's still more than fine. If we use, as I said, hundreds of these things, it's going to be chaos. We're not going to understand the chart. So Confluence is good, but if we use too many of these things, there's always going to be Confluence. We're never going to be able to trade. There's going to be a total chaos. So there is a max. Otherwise, after that max, it's just becoming not usable, not important, just impossible to analyze. So here we have a Confluence, for instance, the fact that we got a consolidation box here, we have a downtrend here prior to that, we got moving averages downward, and so there's a lot of Confluence here for the downtrend to continue. It did, it broke the support, and one of the scale outs could have been this and this. Right? And even if you take a reversal trade, one of the scale outs, or the last scale out, perhaps should be at resistance, because there's a lot of Confluence at that level. All right. Time for questions. Anyone else have a question besides about the fibs? I'm going to take a look at some live charts now. It was a volatile day, wasn't it? A lot of movement. The yens were roaring and racing up and down. And pound moved a lot, fell a lot, now it's bouncing a bit again. So there was a lot of activity here going on. Euro dollar moving up, but well, it was a bit of a choppy move up, wasn't it? But other pairs were really moving a lot. Euro odd, pound odd, Aussie was falling like crazy, but rose again recently. So yeah, a lot of things going on. All right, this is pound yen actually. Talked about that in Wednesday live webinar. I said the 50 or 61.8 fib could be a good turning spot for downside, and that was a good one. From the 50 fib down to the minus 61.8 target was 630 pips, for instance. So that was a major fall. And if you manage to hang in there, then you got a very big trade. Down to the minus 272 target was 420. So that could have been a scale out. Scale out to minus 272, scale out to the minus 61.8. That could have been one way of scaling that out. Was there was there any reason to see extra Confluences at those levels? Perhaps yes. Perhaps if we add a fib on multiple of these swings, for instance, this big swing, we could see other targets. Now in this case, not yet, because the target is lower. But the more fibs we add, I'm sure we'll see some confluence between some of these swings. This was the fib I was using most recently. And that worked out very nicely. So let's take a look at some other charts to see if we can see some confluence here. You can see minus 272 target, pretty much equal to this resistance as well. So simple things like that, looking at pivot points, looking at where the moving averages are. Let's take a look at the odd USD here. For instance, the odd USD not only had a 61.8 fib at the turning spot, but we also mentioned in Wednesday and Tuesday webinar that there could be a head and shoulders, right? So that was another reason why there could have been a pause at that spot. So we had a fib, we had a head and shoulders, and a resistance trend line. So if you're aiming for a target to the upside when trading the reversal, then that would have been a very strong level to think about. And it would not be good in general, I would say, to aim beyond that level because there's such a strong confluence at that zone. Why aim for higher, right? Why aim for more if that does not seem that likely? So when scaling out, for instance, we would not want to aim higher than that, but we could aim for part of the position at the 50 fib and part at the 61.8. That could be scaling out to the upside. Scaling out to the downside could have been part at the bottom and trend line and part at the 272 target. And part of the trade is now closed. Part of it is still open. Maybe, if there's no trail stop at least. That would be scaling out to the downside. And is there any confluence with that scaling out to the downside? Well, with this target, we see there's a bottom as well, so that gives an extra reason to aim for that one, and maybe not the minus 272, or split the trade in parts, especially if you see that two zones have a particular importance for whatever reason, because there are multiple things there. Then we might go for the closest or split the trade. Whereas if we see one strong zone and the other zone is a bit weaker, then maybe we can skip that weaker one and try to aim for the one with more confidence right away. So that's it. Basically, there's nothing much left to say, but it also depends on what tools you use, and stick to those tools, but use it in a way that you think, okay, what is the likelihood of price moving down to this level, and what's the likelihood of price going further, and is it worth scaling out at both levels? That's something you have to do with your own tools and see if you can improve your trading like that. I use fibs, and therefore we'll use often fibs for scaling out. I use also sometimes trend lines and moving averages and pivot points as well. But fibs is my main thing. That's the most often tool I would use for any targets, including scale outs. And then I use other things to give a bit of confluence which levels might make the most sense. So that's something you have to consider yourself, of course, which tools make the most sense for you. But now you have at least an idea when you look at your tools. You can judge: is it worth a scale out? Is it worth splitting the trade? Are you doubting whether one or the other level will be more important? And you can do the scale out. All right. So any other questions, perhaps? And then it will take over soon. Just want to check if there are any questions. But basically, yeah, scaling out, great stuff, I think, especially if you're doubting about two levels, especially if you're using fibs, I think, and Fibonacci sequence levels that I talked about in the previous Fibonacci webinar on December. You can take a look at that, and they just give you an optimal kind of a feeling for taking some profit at these fib levels. All right, so I hear Nenet already in the background. Hi, Nenet.
Hi, Chris. I'm here waiting for you. So excellent introduction.
Great.
An excellent take on scaling out. So today, yeah, I will show some also live charts, and traders will see how we actually can use it. So let's see. Let's share the screen first, and then we will see scaling out my part. Okay. So this is it. Confirm that you can see the screen. I think that you can see it, how to scale in and how to scale out part 2. And actually, excellent. Let's get back to our main subject. Scaling out profit stop and effective way to scale out on live charts. So I will be showing you this, and I hope that you will understand it perfectly. So first of all, what is scaling out? Scaling out is, as Chris has already explained, I will be also short with it, it's a taking out exposure in the market. So when you're exposed to some currency pair, you usually want to get out securing some profits. So let's say that you are long on euro dollar, and you see that basically the first resistance will be hit. You don't want to risk anything. You don't want to over-risk, so you just take some part of your profit. Now the thing is, it's in a good synergy with trailing stop, because you will also move trailing stop as the price moves. Now, what is not okay is basically, I cannot say not okay, but maybe you need to sacrifice for less profits. So that is why I always say be focused on pips, not just the profits. Because definitely scaling out will give you peace of mind, because you know that you are riding a free ride and you have already taken some profits. But sometimes, it's a psychological factor with most of the traders, as most of the traders have been focused on pips, on money, not the pips. So basically, when you see that less profits are being made because of scaling out, maybe in the future you will think that scaling out is not so good option for you. Now that is what you need to comprehend within yourself and to make a trade-off. Whether you will risk to scale out, or you want really to have a full trade with full profits. Obviously, when you scale out, your profits will be less, and because of that, a lot of traders simply stray away from scaling out. Now, what is a profit stop? Profit stop is that we move our stops once we are in a trade. I have also showed you on many occasions how I do it, and also you could have seen some of my live trading videos where I move stop loss to be actually in profit. So when you move your stop loss in a profit zone, it's called profit stop. So it's not a trailing stock anymore, it's a profit stop. That way you can also turn intraday position from a scalp trade, or maybe from a small trade you haven't planned to make it, and you just turn it into intraday position. For example, if you open a small trade, let's say aiming for 10 pips, but suddenly you see a huge momentum, as for example it happened today with yen pairs, and you just move your stop as the price goes up or down. So you just move your stop. That way effectively you're turning a small trade or a scalp into intraday position, which can be very, very effective if you have huge surge of momentum in the market. Now obviously if there is no momentum in the market, you can't do it. No, you can't do it. So for that you really need to have a strong momentum in the market. Now what can be very, very nasty for you is when the price suddenly goes against you. So that cannot be quite well for you. But that is why you always want to secure that there is actually a momentum in the market. If there is no momentum in the market, chances are that you will lose your trade. Okay? You will lose your trade. Because you cannot do a profit stop unless you are in the profit first. So first, try to secure the profit, and once you're in the profit, try to secure a profit stop. So the first stage is securing the profits. The second stage is securing the stops. You just cannot do it vice versa. There is no way. Now, it's useful in all time frames. I know that a lot of traders ask me, okay, can I trade this on lower time frames? Of course. Profit stop can be made even on a 5-minute time frame. It can be done also on time frames, but usually you want to make profit stop if the price is close to, or if it's at least it broke a resistance or support. That is when you really want to take on the profit stop. You don't want a profit stop, for example, if the price is only 3, 4, 5 pips in profit. That's not a good way to do it. So you just want to secure the profits first and then do your profit stop thing. So that is how you do it. Okay, so you need to remember it. There is no other way. And forget about taking 2 or 3 pips when you have the chance to actually make a good trade of like 10, 20, 30, or even 50 pips. So that is why I always say on session recap webinars, do not take less than 20 pips. We don't want to take less than 20 pips when we are trading intraday or swing trade. So really that's the lowest point you can take, unless you see that market is turning against you and you actually want to secure profits. That's another thing. Okay, that's completely other thing. But if you see that the market is not turning against you and that the market is still good to trade, then of course you don't want to be part of early profit taking. The biggest mistake most traders make is one of the biggest mistakes, of course, not the biggest. One of the biggest mistakes is cutting winners and basically letting losers run. So never ever cut your winners short, okay? And don't cut your profits unless there is a valid reason for that. You simply don't want to cut your potentially very, very good trade because you think the market will not behave the way you think it should. Okay? Don't do it, guys. Okay? You will be punished for it. Remember, mark my words. Eventually your account will be a loss and it won't be a profit. So don't do it. Always try to stay faithful to your plan. Okay? Believe me, it's always the best thing to do. Stay faithful, stay true to your plan. And think preemptively. Do you think that your trade can really be good if you place a profit stop? Or it can be a complete disaster if you don't use it? Do you want to sacrifice some profits in favor of good pips, good number of pips? Think about it. So especially if you're a new trader, always think about focusing on pips, not the money. Because if you're watching the money, especially if you trade with high leverage, it can be, stressful to see that you have, I don't know, 80 euros of profit with just 10 pips of a trade, and you close your trade because you have 80 euros or 800, let's say 800 euros. That's not a good thing, because you are effectively closing your leveraged position, not your positional trade. So always try to focus on pips. It's much better than to focus on money. So think about this. For example, you have a trade, one position, which equals, let's say, $1 for a pip. Okay? And you have the same position, which equals like $10 a pip. But the logic is the same. Okay? The logic is completely the same. So you use the same logic for this trade and the same logic for this trade. Completely same analysis. But the only difference is you actually enter the market with $1 for pip instead of $10 per pip. Now this is where it gets interesting. And this is where it can be dangerous. Okay? The thing is, if you traded this first account, I am very sure that you would be focused on pips because you don't have a stress. And it's normal, I'm talking from a human mind perspective. It's normal to feel a stress when you see money coming in and money flowing out. It's perfectly normal to be stressed. It's not something which is unusual. But when you trade this account, I'm sure that most of you, of course, will be focused on money. Especially if your account is let's say $1,000 and you have a strong position on that account, such as $10 per pip. Now you will be focused on money because it's $1,000 account. And of course, if you make $100, which is 10% from 10 pips, it's great, right? It's okay. You need to agree, making 10%. But the problem is your practice could be a bad habit. So you might unintentionally develop a bad habit for that, which is definitely not okay. If you develop a bad habit out of this practice, the chances are you will be trading mostly for money, not for the pips. And that's something you want to avoid, guys. Believe me. You want to avoid it. It can be bad for your account. Okay? It can be really bad for your account. Okay? So watch this. $1 and $10. Most of the time, I'm sure you will be watching this as money. So think preemptively, guys. Now let's take a look on live chart. Okay, guys, this is it. Live chart, for example, dollar-yen trade. Let's take a look at this dollar-yen which I have published today. Think it could be good for you? Now think about it. Okay? Think about it. This trade, we have set it up for a potential profit of, let's say, of some, okay, this is 200 possible pips, but at the most. So what happened is, at the time when I published the analysis, the price was somewhere around this region. And it spiked up to almost, it was close to this level here, but it should have spiked a little bit more towards POC to short it. But let's just think that a trade happened. For example, think about it. Actually, you would enter around this part here, right? And you know that you still have, let's say, mini support is this. So let's say that you still have 145 pips till next support. You know what we talked about. We talked about how to find previous swings as level of support and resistance. Our first class, price action trading school, the very first class. And what happened is basically you enter here, your first potential target is here, your ultimate target is here. And what happens is actually you close your trade instead of letting your profit run. You don't do it like that. You want to do a proper profit stop. So once the price starts to go down, find the mini support and exit only at mini support. That is what you should practice, guys. Okay? Finding those mini supports. Remember, press Control and Y on your platform and you will see quadrants. Mark your quadrants. Okay? If you're not sure what I'm talking about, guys, go and visit the very first class of price action training school. And just hypothetical, just for the sake of the webinar, you want to actually scale out here at this place, not after some 5 or 10 pips. You don't do it that way. Okay? So how you could practice this? First of all, try to trade with lower volume. Instead of opening 1 lot trades, for example, try to open 0.1. Of course, it depends on your account. But $1 on $1,000 account, it's okay. It's okay, I need to say. If you know what you're doing, it's okay. If you don't know what you should do, then it's not okay. Okay? So try to open $1 account. $1 trade. Then when you do it, try to practice the pips, not the money. And let me show you. For example, we will use blank. It doesn't matter. We can use blank template. We can put euro dollar. So we press Control and Y. And of course, you place Camarilla or place your own pivot points. It doesn't matter, guys, really. It doesn't matter whether, it's up to you what it works for you. If it works for you, then great. If it doesn't work for you guys, then of course you don't want to put nor Camarilla nor any other pivot points. So only when it works for you. Now you placed your pivot points. Okay, I will place Camarilla. Let me place Camarilla. And this is what you should practice. And also this is a good practice for finding these spots in your chart. Okay, so Camarilla has been placed. So now you see the quadrants. So now focus on previous quadrant. Remember the first lesson. Find previous quadrant high. This is previous quadrant high. Find previous quadrant low. Okay. So on 1 hour time frame, okay, let me clear this screen. I cannot see it clearly. Okay. Okay, now I will clear the screen. Here it is. Okay, doesn't matter. A lot of things here, but I hope it doesn't mind. So, okay. Previous quadrant high, previous quadrant low. You have tried to go long here. Okay. Around this part, because you see that there is some confluence, right? Okay. So here you probably try to go long. Okay, now what you should do is the price is getting close to previous quadrant's high, which is swing high for this period. And when you look at this quadrant, it's actually, see the time, full day, okay, full day, 0, 0, always midnight. So previous quadrant high, previous quadrant low. The chances are that the price will react at those levels, because that is where the sellers showed at the previous day. It's called, we call it historical sellers. You remember it, I guess. So yeah, historical sellers showed up at this spot here. So probably some new selling will happen, which you see here, it happened. Not to the pip, but actually it happened here. Okay? See, it's not that hard. And then is the time when you want to scale out. So if you traded with, let's say, more than 0.1, you open 0.2 or 0.3 trade, the chances are you will probably scale out at this part, placing your stop to break even and letting your profits run. So that is the trick traders do. So scaling out around this level, putting your stop loss to break even, and enjoying a free ride. Means that your second half of your trade will be in profit. So is this clear? I hope this is clear, because actually it's not that hard, but you just need to make it clear, guys, within your heads. It's not that hard. It's actually easy to trade it. Okay, so scale out here, place your trade at break, your trade at break even, and you have secured your profits. That is how we usually do it, guys. Okay, that is how we usually do it. See, it's not that hard. Now, if you see any, if you have any questions, of course, feel free to ask me now. I'm waiting for your questions. Okay, and yes, the first question is, hi Nenad, can you share what T89 is? Yes, of course, I will show you T89, but this is not related to this webinar. But yeah, of course, I can share what T89 is. Let me just, okay, I will share it with you, don't worry. Let me just open up chart itself. Okay. Okay, so T89 is actually this one. Okay, this is it. T89. When you put, let's say we use Camarilla. This is EMA 89. You see, this is EMA 89. Now, usually when you see a tail here, this is T89, but it needs to be bullish. So no, this is not a good T89. It needs to be bullish. Let's find another example. I already explained it in the webinar yesterday, but okay, just for your reference, I will try to explain it again. Yes, this is still, yeah, but this can be, because even though the body is looking bullish, it's still big wick. So this is T89 rejection, really a huge wick. So it is indeed a wick rejection. Okay. So this is T89. Okay. So not easy to spot, right? Not easy to actually chart it. Okay, let's see if we have other example of T89. Okay, let's see. Okay, this is okay. Body is bearish, but you see the wick is huge. Indeed, Alexa. Long tail spiking. Guys, when you see long tail, which is bigger than body, then the body itself does not matter at all. Believe me. The body itself does not matter at all. It's simply enough that this tail is bigger than the body, but it needs to be bigger. It's exponential 89 and close. Yes, exactly. Okay. And one more, so then we proceed. Okay, this one here also. See, even though the body is bullish, this wick is very big. It's much bigger than the body. So you see, this is tail, and this is EMA 89. So we call it tail 89. That's it. Okay. Any question more? Okay, I don't see questions. So guys, about scaling in, I hope that you understood our point here. So you definitely want to follow this per level. So first of all, you find mini support and resistance by watching previous quadrants, and those are, I call it mini because they are still valid even though they were previously touched. So usually you will see it in between two pivot points or Camarilla pivots. So they are good and they are very strong. I call it mini, okay? And basically you just go with the flow. One more example and we can finish the webinar. Let's see pound dollar, for example, previous quadrant. So you mark high and low, high, you mark high and low, you mark previous swings, very clear, double, always double tops, double bottoms, see here. Okay. And for example, if you went short, let's say today around this spot, you could see that the price has had some reaction here. Look, breakout, retest, continuation pattern. See? So this is very clear. Breakout, retest, continuation here. So this was a good spot for you to scale in. So how you do a little trick, small trick. Scale out here. It's stuck. Okay, see it now. So pound dollar. once more, pound dollar. You see quadrants, previous swing high, previous swing low. Okay? Previous high, previous low, important swing. If you shorted it here, you could have scaled out here. Place your stop loss to break even and enjoy a free ride. So that is how you do it, and that is a good trick, guys. Believe me, it's a good trick. Okay, so I don't see any questions. I hope that you find this information useful. As always, practice this because this could be your savior, definitely. Focus on pips, not the money, and try to understand the logic and the principle of scaling out. Thank you for listening. We will be here with you soon. As always, cheers and trade safe.